Sounds good, Annabelle.
Let me, perfect. All right, well, welcome everyone. I hope everyone can hear me. Just please, before we actually begin, make sure your mics are muted. And all right, we'll get started. Very good. Well, welcome everyone. My name is Annabelle Pacheco, and I am an investor and a real estate broker, been in business for 24 years. I am part of a global real estate company named eXp Realty. My goal for this call is really to share with you guys every week the steps that I took to purchase my first multifamily deal. I like to bring guest speakers in from the multifamily space to share with us and just really expand on our knowledge. And I really encourage everyone to participate and ask questions. Let's use this platform really to just share information with each other and learn from each other. This is a safe place. I mean, if for whatever reason I don't have the answers to your question, I definitely have the resources and I can get answers for you. I am not selling anything or offering anything. I'm not a financial advisor. I'm just sharing my story with you guys. Okay. So just a little bit about myself. I started in the mortgage industry in the mid 90s. I was doing a lot of purchase and refinances in those days. And believe it or not, I was refinancing at 9.5% interest rates. So today's rates, I know they've gone up and we're like somewhere in the 5% range. That is still an amazing rate. 2 and 3% was just like a freebie. It was a teaser. You know, that wasn't reality. 5%, it's still a good rate. And, you know, it shouldn't deter anyone from moving forward on any kind of purchase or financing. Anyway, I've purchased over 100 properties throughout my career. I was heavily involved in rehabbing and selling properties in LA. This was here in California. And in 2001, the market shifted a bit. There weren't enough properties for, or at least we were having a hard time finding properties, deviated and went into the restaurant, built a 150 capacity restaurant from ground up. We had a staff of about 15 people, including managers, servers, chefs, everyone. I mean, we had people running this restaurant. That was for about 8 years. And then, you know what, sold it. And it was the best day of my life was when I was able to hand over that key. A very stressful business. And if you are not passionate about a restaurant or just even like maybe a chef or a cook, I mean, it's definitely was not for me. But you know what, we had put our money in there and had to build it and get it to a point where we could actually sell it and make some money. So anyway, the last 10, 11 years, I have focused 100%. My business has been representing clients in both residential and commercial real estate. I purchased my first multifamily deal in 2015 in Texas. And then I have expanded into El Paso, 310 doors, Houston, 180 doors, and just recently went into a hotel development here in Los Angeles and a 300 space parking structure as well in LA. So definitely been working hard and trying to find ways to create cash flow and to create generational wealth. You know, a few years back, I was like, okay, there's got to be a way, right? Like, how can I make our money work for us? And to be honest with you, after analyzing and looking at so many different options, multifamily was the way to go, or anything that creates that cash flow and that generational wealth. And here are some of the reasons why I've invested in multifamily. And really, I hope that it inspires you guys as well to do the same. So number one was cash flow, right? Here's an opportunity where we can actually, we're actually purchasing a property that's giving us monthly cash flow. And in a nutshell, it's rental income minus all of your expenses is your cash flow. Number two, it was loan pay down, right? What great opportunity to have tenants pay down your loan. And it's just part of the numbers, right? It's the multifamily, when you factor out and you're doing all the math, those payments, those mortgage payments or the debt service includes all the rental income that's coming in. So number three, it was appreciation, right? So here's a property that we hope over the long run will appreciate in value. And that's usually the case, right? If you're looking to make a quick buck and you're going to buy something today and hope to turn it in, in a year or less and try to make a lot of money, chances are, unless, something crazy like the pandemic happened and, nobody knew, right? Then that in a year or 2 years, property we're going to double or maybe even triple in some cases. You can't assume that that's the case for everybody, right? It usually takes time. And number four, it was tax benefits. Here we have, the opportunity to depreciate, which allows you to expense a portion of that physical structure each year on your taxes. And then the 1031 exchange, which allows you to pretty much you defer your capital gain taxes, and there's no limit to doing this. So if you find a great opportunity, you can sell your property, you can go out and purchase another property and roll over that capital gain and not pay taxes on it. So I want to share with you guys my first multifamily deal and kind of what I did and how it all happened. It was a value add opportunity. And if you're not clear on what a value add opportunity is, I put the definition there. It's a strategy that involves buying the worst property in the best neighborhood and then increasing its net operating income and the value of the property through renovation. And it's exactly that. Now, it may not be the worst property, right? But as long as like when you're doing your underwriting and when you're looking at everything and you're comparing it to other properties, other apartments in the area, and if you know that if you can improve the condition of your, let's say, you're buying these and you can improve the condition of your units and increase the rents, that's where the value add is at. So we purchased this property for $850,000, and the property needed a lot of work. And I have previous experience in rehabbing and flipping homes, that it was very easy, or at least it came much easier for me to, can you guys make sure you mute your phones, please? It was a natural, it was just naturally for me to know that, okay, these properties, if I fix them up, I'm going to be able to increase those rents. And this is how we created, we improved the value of the property. So basically, purchased this property for $850,000. I negotiated with the seller to pretty much for the seller to carry the note. He was our lender for 2 years. So we gave him a significant amount of down payment. I mean, $350,000 is a lot of money, but we had saved, we had sold the property. So we knew we had the money and we were ready to do this. And to be honest with you, I was in a position where I thought, okay, if he can, if he's willing to carry a note, I'll go that route because it's easier than actually going through the whole process of getting the loan. And I was already overwhelmed as it was with this purchase that I thought, okay, it doesn't matter. We had sufficient money and we thought, okay, in 2 years, we can definitely fix this property up and then we can refinance and what will be good. So everything played out the way that it should. We remodeled. We had 2 years to really like remodel and update the units and increase the rents. And by year 2, our property, when we refinanced, had pretty much doubled in value. So we were able to, at that point, refinance, get all our money, our initial investment, plus more out of this property. And we were at 65% loan to value, had zero of our money invested in this property. And today's value is somewhere in the 2.7 to 2.8 range. So we did very well. And this is like this is a perfect example of what we all would like to see on all of our deals. They don't happen like this, but this is kind of the model, and this is what you want to always shoot for, right? Where even at the beginning, it may have 850 was a lot, but we knew there was that vision that if we improved and increased the rents, for sure, the value of that property would go up. And that's the beauty of multifamily. That multifamily is not based on comparables in the area. It's based on what the property's producing, its net operating income. And if you improve and you increase that income, the value automatically increases. So that's why I like multifamily. So let me show you, here's a picture of the property. There's a 2-story building. These are 24 units, 1 bedroom, 1 bath. And then this is another building which has 10 units, and it's 2 bedrooms, 1.5 bath, and townhome style. So this has like a small yard. Any questions so far? We good? Okay, so I'm going to stop sharing here. And do you guys have a background there? No background? Huh. Can you hear me? Yes?
Yes. Annabelle, and your
Yes.
background is still
Oh,
up.
there we go. Okay. That was just kind of weird there. I went blank there. Okay, cool. So anyway, today I have a special guest, and that's Sharaine Richards. I met Sharaine about a month ago at the Grant Cardone Growth Con in Miami. It was amazing. We all got a lot of information and just inspiring. And, really at the end of the day, we all have to work hard, work together, work smart. And, we connected, we hung out, and we had a great conversation. I told her, you know what, I want to invite you over to my weekly call. I think what you bring, you're going to bring a lot of value to, the people on this call. And so let me just give you a little bit about her. She's CEO of Infinity Business Alliance. She specializes in helping business owners acquire financing. So, I'm sure it's a broad range of different businesses. After experiencing struggles herself, the struggles that many entrepreneurs face when trying to build up their business, she decided to become an advocate for entrepreneurs. So this is the kind of individual you want on your side if you're you're looking for a loan, if you're looking to get any kind of financing for any kind of business. You want someone that's really advocating for you. She takes an active role in guiding business owners through the process of getting the necessary financing to achieve their goals. She spends most of her time connecting with business owners and real estate investors from all over the world. And discovering new ways to help them access resources to grow their business. So welcome, Sharaine, to the call, and the floor is yours.
Well, thank you. Thank you so much. Thank you for the introduction, Annabelle. Thank you for everyone on the call for having me and taking the time out of your day to come to this presentation and listen to me give you a little bit of background about multifamily financing. And as Annabelle was saying, I do with Infinity Business Alliance, we do specialize in financing for all different types of businesses. But for this specific presentation, I'm going to focus on giving you guys information about financing for multifamily property. So I hope that you take something valuable out of this presentation that you can use and be able to apply to your goals.
Awesome. Fantastic.
So you'll, let me share my screen.
Go ahead.
All right. Are you all able to see that?
Yes, I can see it.
Okay. All right. So multifamily investment financing. Annabelle already went over some of the basics and the benefits of investing in multifamily finance, well, multifamily properties in general, but I'm just going to kind of piggyback on that. And, you know, any property that is going to be 2 units or more is considered a multifamily property. So you can start with a duplex, a triplex, 100 units, 500 units, is all considered multifamily property. Now, where the difference comes in and how it's structured is depending on how many units it is will determine if lenders are going to structure it as a residential loan or as a commercial loan. So typically for 1 to 4 units, those are usually structured as residential loans, and 5 units or more are usually structured as commercial loans. And the difference with that is residential loans, they typically, you can get a higher loan to value from lenders. So that won't require as high as a down payment as the properties that are going to be 5+ units. In addition to that, the lenders typically look for you to have a little bit more experience with investment properties if you are going to try to acquire a property that has 5+ units. But multifamily investment is very beneficial, as Annabelle was saying. Like, the difference is that when you're not just dependent on one tenant. When one tenant moves out, you're still going to have that cash flow coming in from the other units. And then people are always going to need somewhere to live. So as long as you do your research and you invest in a good property, you can hold this property in your family for generations and just continue collecting that cash flow.
Mm-hmm.
So how do I acquire a multifamily property? So there's a couple of options that you can use to be able to acquire the property. There's the passive option, which is the real estate syndication. And with that option, you would basically, there's a general partner or operator that will put together the deal, and they'll find different investors to help raise the capital for that deal. And then the investors get a piece of that equity. So that's a completely hands-off if you don't feel like you can get out there on your own and take on that responsibility. One option, you just kind of want to get your feet wet. One option is the real estate syndication, where that general partner is going to be pretty much managing that property themselves. The second option is for you to take on the role as the operator, and you can go out and find investors to raise capital. And this is a good option if you do want to be more hands-on, but you might not have all of the capital for the down payment. So then you would go out, find the property, get that deal structured, find out how much you need to raise, and then go out and find investors to help you raise that capital. And then the third option is to just completely take it on yourself, like Annabelle did, make that entire down payment. You're going to manage the property yourself. If you are just starting out and it is one of the first properties that you're getting into, my recommendation would be to start small, around that 2 to 4 unit range, just because not only is it easier to acquire the financing for smaller properties, because you can get a better loan to value from the lender, so you won't need as large of a down payment, but it's also easier to manage for someone who is just starting out while you get your feet wet to just start with something smaller. So this is what I'm sure what you all want to know. How do I get financing for the property? So there are 4 key areas that lenders are going to look at when they're structuring their loans. And this is no matter what size the property is. They want to see the credit, cash flow, collateral, and experience. And those are typically with the major institutions, they're going to want to see that you have all four. With the smaller banks and the private lenders, which is mostly who I work with, they're going to give you a little bit more flexibility to where, maybe your credit isn't great, but, it's a great cash flowing property, or maybe you don't have as much experience, but you have a really good credit. They'll give you a little bit more flexibility on not having all four of these boxes checked off. So the next bullet, there's a reason why I bolded it and put it in caps. If you don't remember anything else that I say today, this is the key, most important thing with getting financing. If you want to give yourself the best possible chance to get financing from a lender, you should mirror your due diligence process with the underwriting process that lenders use. So basically that means that you need to think like the lender. The lenders they're looking at it like, we're making an investment into this property, and they're making an investment into you as the borrower. So they want to make sure that they're going to get their return on their investment, and it's going to work out good for them. So they're going to make sure that they look at key components of the borrower and of the property to make their approval decision. So my recommendation would be, before you even try to reach out to the lenders, make sure that you've done a good due diligence process. Make sure that your credit is set up to where it's going to be in an acceptable range. So that way you give yourself the best chance of being able to get that approval. So you're probably, well, what do lenders look at? That's what we're going to go over. So underwriting parameters. One thing that the lenders are going to look at is the property type, and properties that lenders consider to be less risky will get you a higher max loan to value. So that goes back to what I was saying with the residential compared to the commercial. So if you're someone who's just starting out and you're trying to acquire a larger commercial loan, it's going to be harder for you to get approved for that if you don't have any prior investment experience to show the lenders that you know what you're doing. Whereas if you start out with the smaller 1 to 4 family unit property, that at least will allow you to have more leeway with the lenders. You can get a better loan to value. They're not going to be as strict at looking at how much experience you have, because they know it's easier to manage a property that's 2 to 4 units as opposed to a property that's 12, 20, 50 units. Another thing they're going to look at is the tenant quality. So if the property already has tenants there, the lenders are going to look at the quality of those tenants, because you have, as Annabelle was saying, the source of the cash flow for the repayment of the loan comes from the tenants. So they want to see, are your tenants consistent? Are they reliable? Do they pay on time? Because that's going to be how you're going to repay that loan. Lease maturity. So the lease maturity profile is the average duration of current leases across all units within the property being financed. So essentially what this is saying is that leases that are longer terms are more appealing to lenders. So if you're acquiring a property and you have leases that, say they're 18-month leases, and just think about, in terms of like most apartment complex, they're going to incentivize you to sign a longer lease, because it's going to be a longer amount of time that they can lock in that consistent cash flow. So if you have some leases on your property that, 6 months, month to month, things like that, they aren't as appealing as the leases that are going to be 12-month, 18-month leases. And then another thing to consider is having the leases staggered. So if you have a 5-unit property and 4 of those units expire, the lease expires in December, then to a lender, this might be a red flag, because if you don't have like a waiting list of people who are just going to come right in and occupy those empty units right away, they are going to be wondering, okay, is there going to be a dip in the cash flow once those leases expire while you wait for someone else to come and occupy that? So if you can try to stagger the leases in a way to where one expires in March, one expires in January. So that way, at least if one person moves out, it's not going to significantly impact the cash flow moving forward. Property condition. So this is where you want to do a tour of the property with a contractor. Make sure you have a good understanding of the issues that the property has. You want to make sure that you're not investing into a property that has environmental issues that could potentially be an issue for tenants. You want to try to get a good estimate of that rehab budget in your loan request, because this is going to be the value add that Annabelle was talking about, because lenders they're all about the cash flow. So if you can be able to make certain repairs and renovations to be able to increase the value of that property, that's a good sign for lenders. But you want to try to get a good estimate of that and include it into your loan request, as opposed to underestimating any repairs or renovations that you can make. And then now you're in a position to where you're asking the lender for more money to cover those repairs, as opposed to if you had already just had all of that ready, a good estimate included into your loan request, you can just take out the draws to be able to do the construction and repairs to be able to get that value add for your property. One thing to consider is if the property isn't in good condition, you may have to do a bridge financing option. And what this basically is a short-term loan, and they usually use these loans for like a bunch of the fix and flip type of properties, where basically it's a short-term loan, usually around 12 to 18 months, and the interest rates are a little bit higher, but that's because it's meant to bridge you until you can stabilize that property, and then you can get yourself a more conventional long-term loan. So if the property that you're dealing with, you find a property that's not in great condition, you may not be able to get a long-term loan right out the gate. You may have to do a bridge financing option to stabilize it until you can get it into a better condition for a more conventional long-term loan. So the cash flow, as I said, it's all about the cash flow. They want to know, is there cash flow? Where will it come from? And this is going to be determined by your lease terms, the ability for you to be able to add value to the property, increase the rents. Is their cash flow consistent? Do the tenants pay on time? If you are dealing with a property where there's not as much cash flow, then you can pretty much expect that you may have a shorter amortization period and you may have higher interest rates. And that goes back to what I was saying with the bridge financing option. You may need to add some more value, do some renovations to that property before you can get into a long-term financing option. Location. So this is one of the most important things to consider because it impacts a lot of other things. So the location determines how much you can increase the rent by based off of the market that it's in. So as Annabelle was saying, with single family homes, you kind of have to look at what's going on around the property to determine where you can go. But with multifamily, it's all about the cash flow. So you have to really just add the value. So if you have a property across the street and they may be in a comparable market as far as how much they're charging, you have to determine based off of this location, okay, how far can I go? How much value can I add to be able to make people say, I want to go stay there? But you don't want to undersell yourself, because sometimes tenants, it attracts the wrong kind of tenants if you're trying to stay too close to that fair market value line. So that's something to consider. And location can also impact the stability of the tenant occupancy. So if you're somewhere that's not around a lot of businesses, it's not an area that has a lot of other things going on, this may be, sometimes some lenders might look at that as a red flag, because if tenants are moving out, how fast can you move tenants back in? How great is the demand to be in this property, to be in this area? So that's just something to consider. It doesn't necessarily mean that I don't want you to just write off properties that don't look like as much going on around it, or it might not be in the best area, because you have to consider what is the potential of the location. What can I add to it? Are they doing construction around it? Are there new businesses coming in? Is there going to be things that are going to help make tenants really make this an attractive place for tenants to want to live at. And then when you do that research, provide that key information about the market in the area to the lender, because that's going to help them see like where the added value is at in this property. For example, I had a client who he knew that there was going to be a new two new manufacturing facilities being built in the area, and it was going to add 11,000 new jobs. Like, that's all information that lenders want to know, because that just increases the value of that property in their eyes, because more people are going to be attracted to areas where they can be able to get good jobs and go to businesses and things like that. So the required documentation is going to vary depending on the lender that you're dealing with, but here's just like a general overview of what you can expect. So you're going to have to submit an application with the lender. They're going to ask you to give the consent to do a credit check, and that's just to verify that the credit information that you gave them is accurate. 2 to 3 months of your most recent bank statements. And this is just because they want to see that you have some liquidity and cash reserves, because if you are looking to acquire a property and say you have your 20% down payment ready, they don't want that 20% down payment to be all that you have. And once you put that out for your financing, that's it. They want to make sure that there's still going to be some reserve there, just in case. We all know in business, there's always something unexpected that comes up. So they just want to make sure that you have that liquidity and those reserves in place. Your REO schedule.
I'm sorry. Can I ask you, while you're on there, how many months reserves should you have in addition to your down payment?
I would say at least have 6 to 12 months, just to be able to demonstrate that, because you have to think about, not only will you have your down payment, but you're going to have your closing costs. And then anything else that's going to be added additional, say you underestimate on your rehab budget. And the way that the rehab budgets are structured is they are essentially reimbursing you for the construction that you're doing. So if you pay for that up front, and then they go ahead and reimburse you. So that's why it's important to make sure that you have some buffer room to be able to cover anything unexpected. If you underestimate their rehab budget, you may have to come out of pocket and cover that until you can go to the lender and explain to them why that was underestimated and why you may need more money. And not to say that they won't approve you to give you an additional financing. Usually they're going to at least give you up to 75% of the after repair value, but you don't want that to be the reason why you can't move forward with doing things, because you don't have that extra cash flow. And you definitely don't want to be in a situation where you start something, then you can't finish it.
Right. Okay. Sorry for interrupting.
No, you're fine. The REO schedule that's your real estate owned track record. And that's just basically an outline of, here's the rental properties that I've had in the past, usually around 2 to 3 years. Here's what I've had in the past. Here's what I currently own. And here's the properties that I've sold. You want to have a purchase contract for the property ready to go when you reach out to the lender. You want to have your budget for your rehab and your renovations, your legal business entity documents, your articles of organization, your operating agreement, and then your rent roll and your lease agreement. And that's just basically an itemized report of each unit. And it says whether it's occupied or not, whether the tenant pays on time, what is their history, the tenant who's occupying that, how long have they been occupying their unit. So it just gives them some detail about the type of tenants that are staying in the property. So here's a little bit of information about the lenders in our network. And I will say that this is very variable. So it varies depending on the borrower, it varies depending on the lender, it varies depending on the loan amount. So this is kind of just like a guideline, but obviously you would have to come to me one-on-one and talk about what your specific situation is, what your need is, to be able to get a good understanding of where you would fit in our lender network. So credit score, some lenders will go as low as 620. But that 620 is typically for investors who have more experience. They're going to be able to still have a 620 credit score and get away with getting a good loan to value because that experience. If you are just starting out and you don't have any experience, I would recommend you want to be at least at a 680 to give yourself the best option to be able to get better terms. The loan amounts that we do typically range from 100,000 all the way up to 250 million. I'm going to be honest, there's really no cap. Like if you find all of a sudden you found a $500 million property and you're ready to go on that, we can find you a lender that's going to be able to help you get the financing for that. But this is kind of just like a range to give you an idea. The LTV is typically 75 to 80% for multifamily unit properties. So you're looking at about 20 to 25% down. The rates are fixed and variable. As we all know, the rates are starting to go up. So the rates are pretty much going to be dependent on the market and depending on the lender. Terms, you're usually going to get a 30-year amortization if it's a long-term rental property. But if you know that this isn't a property that you want to hold on to for a long time, I would say be honest about that up front, so that way they can structure your deal to be able to fit that, because the last thing you want to do is to get into a 30-year loan and then you have a 5-year prepayment penalty and you're looking to pay it off early and now you're hit with the penalty for doing so. So you want to just have a good understanding of how long do you actually plan on to hold this property for before you accept the terms that the lender gives you. Average funding time, the term sheet is you can get that turnaround in typically 24 to 72 hours. And then from there, we can close on that loan in about 2 weeks. It really just depends on the speed of how you move with getting the documentation in that they're going to require. But as long as everything comes in and right away, we can get that closed in about 2 weeks.
Wow.
So what does the process look like? So this is pretty much what the process would be from start to finish. You would find a property, do your due diligence. You, like I said, go on a tour, get an idea of any rehab and renovations that you can make to really add value to that property. Get a good budget for how much it's going to cost, because you want to be able to include that in your loan request. Get a purchase contract from the seller. And if you're coming to Infinity Business Alliance and you're working with me, you would just reach out to me directly and let me know that you found a property and you want to discuss the financing options for it. So from there, I will collect some basic information from you about you as the borrower, your FICO score, what's your experience level, and I will also collect some information about the property. What's the purchase price, how many units it is it what is your rehab budget? And from there, I'm really just trying to get a good understanding of what are the best lenders that we can go to be able to get you the best possible offer. So once I get a good idea of what we're dealing with and what lenders that I can go to, I'll reach out to the lenders that I have in my network, figure out what they can do for you, get some term sheets. And then what I like to do is just keep you updated in the whole process. And as I reach out to lenders, let you know, okay, we got a couple term sheets. There's maybe 1 or 2 lenders that I'm still waiting to hear back from. And then once I have all of the term sheets that we have for the offers, then I would reach out to you, let you know, send you those term sheets, let you know that we can discuss them together, see if there's any negotiation that you would like to try to do with the lender to see if maybe you can get a lower down payment. Maybe you can see if you can get a lower interest rate, try to see what we can do to try to make this loan fit the financing option that you're looking for. Then from there, if you decide that there's a term sheet that you're happy with, you want to move forward and it works for you, I'll go ahead and reach out to that lender, let them know that you want to move forward. They will submit that required documentation that they have for you to, that's back to that last slide with that required documentation. And what I like to do is I like to collect all of the documents at once. So you don't feel overwhelmed if I send you all of the documents and say this is what we need and think that you have to do this like today. I'm going to just collect your information as you send it and compile it all together. And then once I have everything, I'm going to send that complete package to the lender. And then if everything checks out, they'll go over your documents and you'll get approved for your financing request, and you'll be set to go ahead and make the purchase for that property. So can you do this process yourself? Absolutely, you can. But one thing that I will say is if you are going to take it on yourself, just make sure that you are doing your due diligence with the property, but also with the lenders, because not every lender is going to have your best interest at heart. There are some lenders out there who will essentially take on, not really do their required due diligence and take on your loan requests, because in the back of their mind, if things don't go right and you happen to default on this property, well, say you had a 20% down payment, well, now they can foreclose that and it's their property and they just got this property for a 20% discount essentially. So be very careful don't just go for the first lender that you find on Google and everything sounds good. They're going to give me a low down payment. I'm good to go. Just be very careful with making sure that you do your research. All the lenders that I deal with are vetted lenders. I make sure that they are going to do right by my clients. I'm not just going to send you into a financing option with someone who is going to end up cheating you in the end. So if you are deciding that you want to go about this yourself, just make sure you do a good due diligence process. If you're coming through me, you don't have to worry about it. I'm going to take care of you. But if you decide that you want to go about it on your own, just be very careful in doing your due diligence and make sure that you're dealing with a lender that is not just setting you up to be able to foreclose on that property and get it for the discount and take it for themselves. So that's all I have. I hope that it was very valuable information. I hope that you all got a lot out of it. And if there's any questions, I would be more than happy to answer them.
Great information. Yeah. All right. Let's open it up. Any questions? Anyone currently considering buying multifamily? And again, it could be 2, 4, 5, 6 units, or anything above that, that maybe has a question for Sharaine. Sharaine, we've got an expert on the call, so please, ask your questions.
I have one question. You mentioned at last about those that will set you up in order to take the property. Isn't there any form of regulations or agency that oversees making sure their unscrupulous practice doesn't occur?
If you are dealing, you have to think, because you have to prove that this lender did this intentionally or they did not have your best interest at heart when they approved you for this loan. So that's something you have to consider. Like, yes, there are things in place to try to laws that you can go and try to sue them, but how do you prove that a lender gave you money knowing that, say, it wouldn't be enough to cover the rehabs or the renovations, or they gave you money not knowing that it wasn't a good property to invest in for your budget, but they know that they had the budget to be able to do it and take it over. So that's the thing, like how it's hard to prove. You can go through the process of trying to sue the lender, but it can be difficult to try to prove that they had ill intentions when they approved you for that loan.
Okay. Hope that was a good answer, William.
Did that answer your question, Willie?
Yes, it did.
Okay.
So I do have a question. When factoring in the construction cost, I mean, if you could just kind of give us an example, let's say the purchase price like the purchase price, how much can you actually finance in construction or rehab costs? Where are we at with loan to value? What would the down payment amount be? Just kind of, if you could run down, maybe just an example of something.
Yeah. So say you're looking to purchase a property for $200,000 and you go with a contractor and you look at the area and look at the different repairs and the value that you can add to it. And you say, okay, if we put in an extra $100,000 into this property, we can, the after repair value at that point is going to take this property to it's going to take it to $400,000. So essentially you would then go to the lender, and as long as the rehab budget that you're asking for is not greater than 75% of that after repair value, they will give you the max. So you don't have to essentially max it out and take on that amount, because you have to remember, if you're factoring in that rehab budget into the loan, you are essentially adding that to your purchase price when you're taking that on. So, and you will be able to get reimbursed for that now, but you have to remember that initially you are factoring that into your loan request. So that's why I said it's a good to be able to get an accurate rehab budget, but you also, it's better to overestimate than underestimate, because you can get up to 75% of that after rehab value, but you don't want to, you want to make sure that you're still going to be able to afford that down payment that is going to be if you have to pay 80% of that total value, because then now if you're adding in $100,000 rehab budget, now that takes your loan from $200,000 to $300,000, and you need 80% of that $300,000 as opposed to 80% of the $200,000. But on the flip side, if you get into a loan where you're being reimbursed for 80%, 100% of the construction costs, what it essentially means is that 300,000 is going to be what your loan amount is going to be based off of. But as you do that construction and do their repairs, if the lender can, they'll send someone out and verify that what you said that you're going to be using the additional financing for, you're actually doing, they will reimburse you back for that money.
Got it. Fantastic.
Yes.
All right. Very good. Any other questions? Are we good? So who's going out?
I was going to say, who's about to go out and invest in some multifamily?
That was exactly what I was going to say right now. Who is going to go out and buy multifamily in the next 30 days?
I am.
Ooh,
Yeah.
William, bravo. Where are you
Good for
looking to
you.
buy?
Good for you. That's the way to go.
Where, William?
Well, it's a toss up between Texas and North Carolina and South Carolina. So
Okay.
I have a couple of irons in the fire. So
Okay.
Nice.
Good markets. Good markets.
Very good. Well, if you need any financing, connect with Sharaine.
I would be happy to help you, William.
thank you.
William,
Sharaine, do you work in all markets?
I'm sorry, what was that?
Do you work in all markets?
Yes. We work throughout the US as well as some international as well. Typically all US territories we work in.
What area are you looking?
Okay, thanks. I'm in Georgia.
Oh, okay.
Oh, I'm in Georgia. What part
Oh,
of
okay. I'm in Alpharetta.
Alpharetta? Okay, I live in Marietta.
Oh, okay. That's not
Yeah.
too far.
Yeah,
Yeah.
it's not far at all. If you wanted to meet with me one-on-one, we could definitely set something up.
Sounds good. Yeah,
Yeah.
definitely. I'll take your information. Thank you.
You're welcome.
Awesome. Miss Ty, how are you? Guess who's on our call, Sharaine?
Is Ty here?
Yes.
I am well, thank you. Yes, I heard it all.
Hi, Ty.
Hi.
What a surprise.
right? I sent her
wouldn't
a
miss
quick
it. Wouldn't miss it.
text.
Love you guys.
Oh,
Ty,
Love
thank
you
you so
guys.
much for joining us. It's nice to
Absolutely.
hear your
Absolutely.
voice. I miss
yeah.
you,
Wouldn't miss
ladies.
it.
Awesome. Well, we all met at the Grant Cardone Growth Con. And
She's the third amigo.
yeah, exactly.
Yes.
She is the third amigo. But anyway, yeah. So you know what, Sharaine, thank you so much for sharing. I think you've definitely brought some valuable information to everyone on this call, and definitely take down her information, make a screenshot or take a picture of it and keep it in your, just keep it there. You never know when you're going to need her help. And again, she is just an advocate for business owners and real estate investors. I mean, she's out there to look really for your best interest.
Right.
And so Sharaine, thank you. And you've done an amazing job. Thank you very much.
Thank you, Annabelle, for having me. It was my pleasure. As Annabelle was saying, my goal is to be able to just continue to advocate and help people, because if ownership is your goal and that's what you're striving for, you should have access to the resources to be able to do that. So I take that personally, and I'm going to do everything in my power to try to help you accomplish that goal. So feel free to reach out to me, even if you feel like I'm not ready, but I just have a couple questions. You can shoot me an email, you can call me, send me a text. I will be happy to answer any of your questions and at least give you an idea of how you can get started with where you are in your specific situation.
Perfect. And if you guys would like to put your information down on the chat, I can also send that over to Sharaine, and then she can connect with you guys as well. So feel free to put that on the chat if you'd like more information. Awesome. Very good. Bill Gross, thank you for joining us. Ellie, thank you very much for joining us. Thomas, thank you so much for joining. I love it when you're on the call.
Yeah, thank you. Trying to get back into it a little bit, a little rusty here, Annabelle, but I was listening. Thank you again, Cherie. Also, thank you for all your information.
Oh, you're welcome.
Hopefully,
My
hopefully I'll be using it in the future.
You will. You will. I know that you will.
Yeah, thank you, Annabelle.
My pleasure. Well, all right, let's see here. It's 2:57. If there's no more questions, I am going to say goodbye to everyone. Next week.
Before we go, I just want to say kudos to you, Annabelle, like for you to go out of your way to be able to put together, to try to connect and help people be able to get access to the resources to be able to grow. As you said, you're not selling anything. You're pretty much just taking time out of your day to try to help other people learn and help them gain the knowledge to be able to help themselves. So I applaud you for that, honestly.
Well, my pleasure. I think that it not only I'm helping others, but I'm also learning myself. It's just exposing ourselves to all these great things. And there's, believe me, there are so much out there, so much that we all don't even have, we just have not even tapped into.
Right.
So really my goal on this call is to do that, is to share as much information with everyone that, that obviously has to do with multifamily space or just investing, whatever I can. You know what? I'm here to share it with everyone.
Awesome.
So thanks,
Awesome. You're amazing.
Thank you. Thank you. And have an amazing day. Make sure to follow me on YouTube. Like me there, social media as well.
What's your YouTube?
Jess, what's my YouTube? Let's see here. Jess will probably put it, let's see here. Jess, are you there? Did I lose her? I think maybe. I think I did. I'll email it to you.
Okay.
Hey, Bill Gross, you're very techie. Bill Gross is my business partner. I don't know if he's on the call. Bill Gross? Bill? Yeah.
He probably left.
Yeah, he probably left. All right. Well, I'll email it to you. But I
gotta subscribe.
if you guys have registered for my event, right, you're going to get an email. As soon as this call is done, you'll get an email and it'll have the YouTube link. Just click on it, subscribe. That way you'll get notifications if I ever do other calls. You know, we normally try to ahead of time share what the topic will be. So make sure to follow me on social media as well. Anna Patch 1 on Instagram and Annabelle Pacheco on Facebook. All right, everyone, have an amazing week or rest of the week, an amazing day. Sharaine, thank you again so much. Ty,
Thank
it was
you.
great seeing you. Thomas, William, Bill, Ellie, everyone. Thank you guys so much, and we'll connect next week.
All right.
Thank
Have
you,
a great
ladies.
one,
Great
everyone. Thanks for
presentation.
having me. Take
Thank
care.
you.
All righty. Thank you.
Bye.
Bye.